Alright guys, so I hope you're doing fine as always. I'm just making a quick video more about the basics of the market and understanding the market. So this is a video you can always look back to if you're unsure about just the basics and how the markets move and what to look out for and basically what makes the markets move and who make the markets move. At least in my opinion. Other people can have a different view, of course, but this is how I see it. So, first of all, a market is nothing more than just an auction between buyers and sellers. So, there's people buying the market and people selling. So, markets is always a zero-sum game. If you are buying here at 62,870, someone is selling at 62,870. So in order to buy, there needs to be someone to sell. So that's also the tasks of market makers. Their task is to provide liquidity in the market. So when someone is buying or selling, there will be always someone to buy or sell these positions from. And in many occasions, this is the market makers. So they make sure the markets stay liquid and you have always the option to buy and sell. This is identical for the futures market or the perpetual markets. So whenever you go long at 62,870, someone is going short at 62,870. Same here, it's also the job of the market makers to keep these markets liquid and provide the liquidity to do so. So you got to keep that in mind. If you go long, someone is going short. So if we have a look at Bitcoin here, for example, with our vector candles, we use these vector candles to spot the, um, how to say it, to spot activity of the market maker. So if we see this long green vector candle over here, this means that market makers is opening short positions. So there's a lot of people longing, so they have to go short. So they open shorts here, 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 here. So knowing that market makers are opening short positions, we can be pretty much sure, or we do expect, price to come back into this vector candle for the market makers to close their short positions. We can see that happens here pretty much perfectly, a full recovery. So they are closing their short positions, and in this move back down, they are opening long positions with the red vector candles. So they're opening longs here, so we can expect somewhere in the near future that they will mark price back up in order to close these short positions. And this is how they make their money and they can keep providing liquidity in the markets. Let's turn this back off for a second. So that's the first thing you need to really understand in markets. There's always people buying and selling. If you buy, someone is selling. If you sell, someone is buying. If you go long, someone is going short. If you go short, someone is going long. So this is also what institutions know. So they set up traps for retail. So let's say, for example, because in markets, really, the retail traders become the liquidity. It's very rarely for institutions to become liquidity. They hunt down the retail traders. And how do they do that? With patterns. So they set up different patterns in the chart. So let's say, for example, the most commonly known or used one is a trend line. So let's say we have somewhat a trend line over here. Retail is drawing these trend lines. They see, oh, we bounce off it, we bounce off it. So where is retail shorting again? Somewhere over here. Wherever we touch the trend line again, because we can draw this line in the chart, so price must react of it, right? What happens? We break above it, come back below, we break above it again. So in this zone, we take liquidity from retail traders just following the trend line. After that, we break down again and we come back up. This is just on the 5-minute time frame, but you could also find this on bigger time frames, for example. Let's go back. So let's say over here is a clean one, something like this. So retail is seeing trend lines as zones of support because we bounce of it always. So we bounce here, we bounce here, we bounce here, we bounce here. So they open longs again here because we're testing the trend line again. And usually you have a few candles that do respect the trend line. This is where they trap retail traders for them price to break down and liquidate everyone who is just trading the trend lines. Prices are not magically reacting based off trend lines. So just if you think about it, why would price react just because you can draw a line into the chart? It doesn't make any sense, but yet it's one of the most commonly used strategies is trend lines. Because support and resistance. But no, this is just a tool for market makers and institutions to trap retail traders and then take their liquidity. This also goes for, let's say, example, bull flags, triangles, even Elliott waves, smart money concepts. So these are all strategies that institutions know retail is using. So they set up these patterns in the chart to get retail excited, to make retail enter in the trades, and to then liquidate them. Because without retail traders, there would not be a market anymore. Because who's going to provide liquidity? And that's also why 99% of the traders do fail and lose money. It's because they trade these strategies that they learn on YouTube or learn online, but are really just designed to liquidate them and make them lose money. It's the market makers and the institutions that set up these patterns. So, for example, a 5-wave pattern. You can draw it. So we have our pattern, let's say here, 1, 2, 3, 4, 5. So retail is expecting an ABC correction, so A, B, C, but we will see a small retrace, so we could have something like this. Let's change the color real quick. So we could see an initial reaction, so retail gets excited, they jump in, but then we go instantly down and continue the move back down, for example. So market makers, institutions know retail is watching these waves. They enter here and they instantly get liquidated. These are just examples. You gotta keep in mind these strategies. Many people use them. They can be profitable because at the end of the day, they need to allow these patterns to play out in different times. Because if they never play out and they always go for liquidations, that means no more retail traders will be using these patterns. So it's good to look for patterns, let's say an Elliott wave, for example, or a trend line, And if you again go look at CoinEnk or at the bookmap to see how many orders are sitting there, if there's a lot of orders, a lot of liquidity sitting there, there's a higher chance that they will fake that pattern to take out the liquidity. So the more retail traders are jumping in on the specific pattern, the more likely it is for them to reverse price and take that liquidity. If there's only a little amount of retail traders jumping in, then it's not worth for them to liquidate them and they let the pattern play out. So when people look in hindsight at the chart, they see, oh, here was a nice Elliott wave that played out perfectly. Here was a nice trend line that got respected. So you have another bounce of your trend line, for example. So that are really the things to keep in mind pattern-wise. Another common theme I see recurring is people saying, or people misunderstanding the buying and the selling in the markets. So when they see prices going up, they're saying, oh, everyone is buying. But a market going up is a seller's market. So this includes people are selling. But for this, we can have a better view on CoinEnk. So now I'm on CoinEnk. I'm using the large order indicator over here. This is showing me buy orders and sell orders. You can also go to the side here to have a clearer view about sitting orders from the ask and the bids. So the bids and the asks, it's sells and buys. For this you can also use the bookmap, which I went over in the previous video. So if you haven't seen that, you can always go check that one out. Today we'll stick to CoinEnk. So what do we see here? For example, we have this strong move up, but what is happening? These are all selling orders getting filled. So like I just said, for every sell order you need a buyer, and for every buy you need a sell. So in theory, or if we are being 100% realistic, it's both a buyers and a selling market. So people are buying and selling for prices to go up. But we're speaking here of a seller's market. Reasoning, if you can have a look. So previously it looked like this. So there's a lot of sell orders sitting in the market. Here there's not a lot of orders sitting, but here there were. So we have a lot of selling orders. These sell orders are usually institutions or big players that want to fill their positions. They want to get rid of their holdings, so they are marking prices up. They are marking price. Let's just turn this off real quick. They're marking prices up in order to sell their holdings, in order to fill their positions here. And then they expect price to come back down, to buy in low again, sell high. So everyone knows the saying, buy low, sell high. This is purely what institutions do. They buy low, they sell high. What does most of retail do? They buy high and they sell low because they jump in FOMO and they sell in fear, resulting in a loss. So you can be asking, if they are selling here, who is buying? This is mostly retail that is buying, or market makers. That's also an option. If there's a lot of people selling, market makers have to step in to buy and provide the liquidity. But mostly it's retail traders buying the move up and selling the move down. So who is selling here? That's the institutions, also market makers. There. And who is buying here? That's also institutions and market makers. So they sell when prices are going up, hence why it's a seller's market, and they buy when prices are going down, hence why a movement down is a buyer's market and not a selling market. As people say it's a sell-off, it's a sell-off, but a move down is usually institutions buying or whales buying the move down. You could see here they're buying 1 million, 1 million, 7 million, 3 million, 18 million. So they're buying all these orders back down in order to sell up higher again. So when prices are going down, the buyers are in control. When prices are going up, the sellers are in control. That's very important to know, and it's counterintuitive. So you would think if prices are going up, the buyers are in control, but it's really the sellers. If prices are going down, the buyers are in control, not the sellers. So that's that. Let's go back to TradingView. So we went over who is making or who's driving the markets, when it's a buyer or seller's market, who is providing the liquidity, which is very important, which comes tied to the vector candles. At least this is one tool to use in order to try and spot them. So we went over that markets are a zero-sum game, so there's always someone selling when you're buying and the other way around. Is there anything else we have to look for? Or maybe what I forgot with the coin ink, how this can be used then. So we can, for example, look over here where the big orders are sitting. Right now the book is looking pretty dry, at least at the sell side. At the buy side we still have this 62,500 and 70 million orders. So if we only look at the bids and the asks, nothing else, so no other strategies, we can assume that they want to go a bit more down to fill these orders. Reasoning: markets move from liquidity pool to liquidity, so every time big orders get filled, more liquidity is provided to the markets. So they want to fill the big orders. So here, for example, this, where was it? 62,500, I think. Here, the 17 million order. It's an order of usually an institution or a whale who wants to fill his order in order for prices to come back up and to sell it higher. But they need price to come back down first to buy, to then sell when price is coming back up. So you can use these big orders, either here on CoinAnk or in the bookmap, to spot what the sentiment is of the institutions and the whales, to see where they want prices to go, if they are in a seller's mood or in a buyer's mood. So just speaking of the orders we're seeing at this exact moment in the book, we can expect prices to come back down a little bit more. Nevertheless, these orders can be put in the book map or into the charts every single minute. So in 2 minutes from now, for example, someone can add an 300 or 200 million sell order in the map, in the book, and then prices might go up in trying to fill that order. So it's really a very active game. That's where you have the book map. You can follow it in real time. So you don't have to sit here and always scroll through. You can watch it on bookmap in the visualization with the big circles and the live book, so the live order book. So both have the exact same function, either the CoinAnk large order or the bookmap, but just a different view If you want a quick overview of sitting orders, I prefer CoinAnk. If you want a real-time view, the bookmap is a lot better in my opinion. You can see here also there's 21 million orders sitting at 66,300 to sell. So we can expect prices to move there somewhere in the future as well. Unless they might spoof or pull their order, or they can keep it sitting for weeks. You have sometimes see orders sitting for 2-3 weeks in the order book as well. So it doesn't mean we have to go there instantly, but you want to see if there's any big order sitting nearby the current price, then there's a good likelihood we're going to try and fill these orders. So I think we went through the basics of what you need to know in order to try and understand the markets, at least in my opinion. If there's any other things that I missed in this video, you can always let me know in the Discord or in the comment section, and I might make a follow-up video for this. But for now, I think this is already a long enough video, so we don't make the videos too long in order to not bore you and in order to not make you fall asleep. So, as always, guys, take care, and if there's any questions, please let me know in the Discord or in the comment section. Take care. Bye bye.